We are back for class 30 if you're in Monday, Wednesday, Friday. So this is the second video. If you're in Tuesday, Thursday, this is actually the fourth video for class 21. So breaking it up into little pieces for you there, Tuesday, Thursday. So we're going to talk about payroll, so getting paid. So if you've ever had a job, you've noticed that your take-home pay is not exactly matching with your salary, right? So you get paid a certain amount per hour, you work that many hours, you don't actually take home that full amount. There's some taxes that come out, and we're going to talk a little bit about that. Now, don't worry too much about how to calculate this stuff, because there's a lot of payroll taxes that go on, and the book talks about how to calculate them, but I just really want you to know how to make the journal entries. So I'm going to give you on exams like the amounts of the Social Security or the unemployment tax, okay? So don't worry about so much about how to calculate, but as to what they are and where they go, what accounts they go to. All right. So payroll, also called employees' compensation, also creates liabilities for a business. For service organizations such as CPA firms and travel agencies, payroll is the major expense. Labor cost is so important that most businesses develop a special payroll system. There are numerous ways to label an employee's pay. Salary is pay stated at an annual, monthly, or weekly rate, such as $62,400 per year, $5,200 per month, $1,200 per week. So that's salary. You just get a flat amount no matter how many hours you work. Salary, like managers. Wages are pay amounts stated at an hourly rate, such as $15 per hour. So probably a lot of the jobs you've had so far are wage type jobs. So if you work in retail, maybe you make $10 per hour, and however many hours you show up, that's your wages. Commission is pay stated as a percentage of a sales amount, such as 5% commission on a sale. So a realtor who earns 5% commission, for example, earns $5,000 on a $100,000 sale of real estate. Now, this is common in your sales organizations. Bonus is pay over and above base salary or wages. A bonus is usually paid for exceptional performance in a single amount after year end. So I worked for a company that did this. At the end of the year, they would sit down and look at what kind of year they had, and they would pay a bonus based on the profits. Benefits are extra compensation items that are not paid directly to the employee. Benefits cover health, life, and disability insurance. So companies have many benefits they offer. Frequently they'll have retirements and insurance are the big benefits, retirement and insurance. And some of them have other things, like gym membership or health savings accounts, all kinds of things. And those are just extra that aren't compensation, right? They're not paid directly. All right. So let's talk about the difference between gross pay and net pay. All right. So two amounts are important for accounting purposes. Gross pay is the total amount of salaries, wages, commissions, and any other employee compensation before taxes and other deductions. Net pay is gross pay minus all deductions. It is the amount of compensation that the employee actually takes home. So you will probably understand the difference between gross and net. If you've ever had a job and you thought you made a certain amount per hour, if you worked 40 hours, for $10 an hour, you grossed $400. But when you went to pick up your paycheck for that week, you only got $325. That's your net, because they took out all the income tax for you, and maybe your health insurance, and maybe Social Security for sure. All right, so they took stuff out. So your gross is like your top line, right? Your actual full wage. Your net is after you take out all those deductions. So what all kind of deductions go on? Well, the federal government, most states, and many municipalities require employers to deduct taxes from employee paychecks. Insurance companies may also get some of the employee's gross pay. amounts withheld from paychecks are called withholding deductions. Payroll withholding deductions are the difference between gross pay and take-home pay. These deductions are withheld from the paychecks and sent directly to government, to insurance companies, or to other entities. Payroll deductions fall into two categories: required deductions and optional deductions. Required deductions include items such as employee federal and state income tax, Social Security tax, and other deductions required by federal, state, or local laws. For example, employees pay their income tax and Social Security tax through payroll deductions. Optional deductions include insurance premiums, retirement plan contributions, charitable contributions, and other amounts that are withheld at the employee's request. So a lot of times employees withheld extra stuff that people want withheld, and that's optional. So let's talk about withholding for employee income tax. U.S. law and some cities and states and counties require companies to withhold income tax from employee paychecks. The income tax is deducted from gross pay and is called income tax withholding. The amount withheld depends on the employee's gross pay and the number of withholding allowances he or she claims. For federal withholding, an employee files Form W-4 with his or her employer to indicate the number of allowances claimed for income tax withholding. Each allowance lowers the amount of tax withheld. So here's an example of a W-4. I'm not going to expect you to use or read that, but when we're doing exams or things in this class, I'll just tell you the employee's federal income tax withholding is some certain amount. It's a little difficult. You have to use tables, and to actually figure that out, it's a little complex. So we're not going to worry about figuring it out. But this person is married with 3 allowances, so they're going to have a different withholding from somebody even who makes the exact same salary, but who's not married or who doesn't have any allowances. So withholding depends on different things, and we're not going to worry about actually calculating the amount, but I would just tell you, here's the amount. Another thing that's always withheld from everyone's paycheck is Social Security. That's what we call the Federal Insurance Contribution Act, FICA, also known as Social Security Act, created Social Security tax. The Social Security program provides retirement, disability, and medical benefits. The law requires employers to withhold Social Security FICA tax from employees' paychecks. The FICA tax has 2 components: OASDI, which is Old Age Survivors and Disability Insurance, and Medicare. OASDI provides retirement benefits to individuals based on age, benefits to survivors of qualified individuals, and disability insurance to individuals who cannot work because of a medical condition. The Medicare portion of FICA provides health insurance to individuals based on age or disability. Medicare applies to all employee earnings, which means there is no minimum tax. All right, so the government's going to take out, we just talked about income tax based on how much you make and based on your withholdings. Then they're also going to take out, your employer will withhold FICA, and FICA includes your OASDI and your Medicare. Payroll register. So many companies use a payroll register to help summarize the earnings, withholdings, and net pay for each employee. Exhibit 11.2 on page 564 shows an example. So as you can imagine, with all this withholding, it starts to get a little complex. So for each employee, they keep track of their earnings, they keep track of the withholdings, and see there's a lot of them here: OASDI, Medicare, income tax, health insurance, other, total withholdings, net pay, what check they paid it with. So they keep track of it all in a special separate journal, really is what it is. It's the payroll journal. So basically what employers do, so you're the accountant working for an employer, you have to do payroll, right? So you have to keep track of each separate employee in your payroll register. Then when you journalize those expenses and those liabilities, you just total up everybody's, right? So you kept each employee separately, and then you're just going to use these totals when you journalize the transactions. So here you go, journalizing employee payroll. The payroll register is used to record the payroll journal entry. Payroll and payroll withholdings are recorded as liabilities until the amounts are paid. The totals from the payroll register will be used to create the journal entry for Smart Touch Learning. So as you can see here, the salary wage expense is the total, and then they break out all the payables: FICA, income tax, health insurance, United Way, salary, and the salaries, the actual net that they're going to pay out. So you record the whole thing as an expense and break out each withholding plus what you pay the employee. Now, on top of what employers withhold from the employees, so on top of these withholdings that they send out as payables, there are at least 3 payroll taxes that are not withheld, but they just pay. The employer just pays them. They're not withheld from the employee. The employer comes out of pocket for them. So in addition to income tax and FICA tax, which are withheld from employee paychecks, employers must pay at least 3 payroll taxes. These taxes are not withheld from employees' gross earnings, but instead are paid by the employer. Employer FICA tax, which includes OASDI and Medicare, so the employer pays some on behalf of the employee, and state unemployment compensation tax, which we'll just call SUTA, and federal unemployment compensation tax, which we'll call FUTA. Employment compensation tax is a payroll tax paid by employers to the government, which uses the cash to pay unemployment benefits to people who are out of work. So when people collect unemployment, that money's there because the employers all chipped in for it. So the employees didn't pay it out of pocket, but the employers paid it for them. All right, so employer payroll taxes. So before we were talking about employees, right, and the stuff that's withheld. Now we're talking about employer taxes. Exhibit 11.3 shows the distribution of payroll for an employee who earns $1,000, assuming the employee has not reached the payroll tax limits. So here you go. It breaks it down into employees and employers, right? So the employer is paying a total of $1,137. $1,000 of it got withheld from the employee, and the rest of it came out of the employer's pocket. Now in this class, I will never calculate FUTA or SUTA or FICA. You'll just be told the amounts and be able to do the journal postings. So let's look at journalizing employer payroll taxes. So the SUTA, FUTA, and the employer's part of FICA. As with employee contributions, the federal FICA OASDI is determined as 6.2% on the first $117,000 earned by each employee. Smart Touch Learning must pay OASDI tax on all employees. However, the amount paid on James Colon is limited to the first $117,000, right? So that's what we're considering here. FICA Medicare applies to all earnings at a rate of $145. So here's an example of payroll tax expense paid by the employer. None of this was withheld. So payroll tax expense 2073, FICA, OASDI, FICA Medicare, because they're at different rates, right? FUTA and SUTA. All right, so those are the employer's payroll taxes. And so you've got the payroll tax expense and then all the payables. FUTA is 0.6%. SUTA is 5.4% tax paid on the first $7,000 of each employee's earnings. Smart Touch Learning will only pay employment taxes on Lisa because all other employees have earned more than $7,000 to date. Smart Touch Learning records the employer's payroll tax expense as a debit to payroll tax expense and a credit to the various accounts payable. All right, so same idea, payables and an expense. You won't have to calculate these, so you don't have to worry about that. Oh, did they earn $117,000 already, or did they earn $7,000? Don't worry about that. I'll just tell you. SUTA, FUTA, FICA. I'll tell it to you. Internal control over payroll. Okay, so you can imagine payroll involves cash. People want to get more cash, so we have to have internal controls that make sure all the payrolls kept right. There are two main controls for payroll: controls for efficiency and controls to safeguard payroll distributions. Payroll transactions are ideal for computer processing. The payroll data are stored in a file, and the computer makes the calculations, prints paychecks, and updates all records electronically. In addition, companies may require direct deposits for employees' pay so that paper checks do not have to be written to each employee. Direct deposit also increases efficiency by reducing the amount of reconciling needed on outstanding checks. A controller of a small business can monitor his or her payroll through personal contact with employees. Right? You know who you've paid. Large companies cannot. A particular risk is that a paycheck may be written to a fictitious person and cashed by a dishonest employee. To guard against this, large businesses adopt strict internal controls for payroll. So that's all we're going to talk about in terms of payroll. So remember, yes, we're going to have payables like FUTA, SUTA, and FICA, but I'll just tell you those. We're not going to worry about all those calculations.